Hello, everyone. Thank you so much for joining us today. I'm Marcia, the webinar director here at Advice Chaser. We're glad to have you here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenters will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number or email address as well. If we can't get to your question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's presenters. Catherine L. Sagin is the President and Executive Director of Christian Foundation of America. Her, excuse me, I lost my place there. Her career in philanthropy spans 37 years. She has served on the board of the Christian Foundation of America since 2002. A career executive in philanthropy, she served as Chief Financial Officer of the Fuller Foundation in Pasadena, California for over 12 years. Previously, Ms. Sagin was Chief Financial Officer of 2 multi-billion foundations, as well as the California Endowment, and as VP for Finance for the Kellogg Foundation. She is a member of the American Institute of CPAs and the California Society of CPAs. Catherine is passionate about bringing Christian-based stewardship, philanthropy, and giving services to families and ministries. And our second presenter today is Ransom H Adams, who is a partner and wealth manager at U.S. Capital Wealth Advisors. He earned a bachelor's degree in financial planning from Texas Tech University. He holds the designation of Certified Financial Planning Professional and has over 15 years experience in the financial planning world. Outside of work, Ransom is a husband, father, and an Eagle Scout. Ransom is based in Austin, Texas, but serves clients throughout the United States. And I'm so excited to have you both here today. This is another webinar that you are doing together. We put these two together and they're such a good team. And I'm excited to have you two present today. So I believe we're going to start with Kathy, and I'll turn the time over to you.
Great. Thank you. Yeah, we call this surprising family legacy benefits with charitable remainder trusts. I think most folks know about using family trusts or living trusts as part of your estate planning. But this is a special trust type that gets called a charitable remainder trust. And we wanted to share some of the neat things that you can do with that on this seminar today. So I just want to say it's fun to be presenting with Ransom again. We're going to tag team back and forth on all of this. So when you do your estate planning using a living trust, that's a core document that you always need to have to take care of all of those things that you would like to take care of for your family legacy and inheritance. And so that's a core. A living trust is something you absolutely have to have. What we're going to talk about today is the possibility of adding another trust type called a charitable trust. And in thinking about that, this first question comes up, why would people consider a charitable trust? the question that comes before that is, why would people do charitable giving? And so for all of you who have charitable giving as part of your lifestyle now, the things that you care very much about, you're doing that for a whole bunch of reasons. We know that. It's a pay it forward and gratitude and thanks. It's part of our values to want to be generous and share with people in need. People support their churches, public charities, all kinds of organizations with charitable gifts. This is in addition to giving that you might do directly with family members or friends or things like that. And so it's making an impact on organizations, people in the communities you care about. It's a way to make a difference in the world and to impact the community your family will inherit. When we spend a lot of time talking with families about legacy and inheritance, and this is an area where we find ourselves working hand in hand with other professional advisors like a trust and estate attorney or a financial advisor. And we love to expand the conversation about inheritance for folks to consider the communities that our families will inherit, as well as any direct resources and wisdom that you pass along. So we just encourage you to think in that way. Okay, so there are different ways of giving that we're going to cover in the course of this. I'm going to do most of the initial presenting on these charitable trusts. Ransom's the expert on insurance, and we can both talk about how it fits in an overall estate plan. Okay, shall we get right in it? Okay, so using charitable trusts in your retirement planning, and I want to talk about two very particular life things that are going on right now. One is downsizing, and the other is retirement. And so there's a way that you can combine income security and savings. We can convert a lump sum inheritance long-term for, you know what, I'm having a little trouble because let me see if I can move this. It's covering part of my slides. There we go. Convert lump sum inheritance into long-term income for children. We don't want to let your life decisions rob you with taxes that can be avoidable. So you're going to see some pretty creative ways to save taxes. And it's a way to lock in a future bequest to charity that will also save you taxes today. Okay. So what is a charitable remainder trust? Think about if you could have an instrument that allowed you as part of your legacy giving to allocate a portion of your estate assets that would be structured to do these several things. The first one is to ensure family income for your lifetime. The second is that you can reap a charitable deduction today for the promise that you've made to leave a gift to charity after you pass away. That's always a really exciting and intriguing option. It can reduce or eliminate capital gains taxes, income taxes, and estate taxes. That gift to charity that you wanted to make as part of your estate plan is folded into this trust structure, so that it's completely taken care of when the trust matures. And so it's a way to advance a bequest that provides tax benefits today and flexible features. I'm going to talk about 3 different stories this morning. And this whole flexible feature area, we won't have time to really give you a lot of examples of that. Just know that if you're intrigued by any of these ideas and you want to learn more about a charitable remainder trust, that we or somebody that is knowledgeable in this area is going to be able to show you a lot of features and options that go along with this structure. Okay. So the first story I want to share is about downsizing. And boy, is this going on today, right? I mean, we're in what's called the greatest wealth transfer in history. The boomers and the seniors over that, downsizing is well on its way. People are moving around, wanting to simplify their lives. And in a lot of pockets in the country, it's quite possible that you've owned your home, or you may own second property also, that has accumulated so much in value over the years that even after you take into account the capital gain exemption for a single person of $250,000 a year, or the exemption for a married couple of $500,000 a year, that you're still staring at a very large capital gain that you have to pay on the sale of your house, which is one of your major lifetime assets. And so we find families will often delay a life decision like that because they don't want to deal with the capital gains tax. They procrastinate. So a CRT is a really unique way to reduce or eliminate capital gains tax, and also can reduce income tax. And I'm going to show you an example. We'll talk about that a little bit, how that works. Then, so what can happen is if instead of selling your property, having to pay capital gains tax, that takes down the net proceeds down to a much lower level, it's possible to retain all the net proceeds from the sale of your home and have that invested to produce lifetime family income, which is what most people do. Although a lot of people need part of it for the downsizing. We're going to show you a way to satisfy both of those. Again, by using a charitable trust, that promise that you are making to charity after you pass away gets locked into this trust type. That's how you get the tax deduction, and we'll show you how that works. So you're getting that tax benefit today. So I want to show you with an example of Betty Lee, and who has a vacation home that became a benefit, not a burden. So let's go to the next slide. I'm going to tell you a little bit about Betty Lee. She's a widow. She's 75 years old. Like so many families, their family had a second family vacation home that they loved. They took all their family vacations there when their kids were growing up. And when they became parents and had grandkids, they went there for years. But now at this stage of her life, people have scattered around, they've gotten busy, and they're just not using that vacation home as much as they used to. And so Betty Lee's feeling a little down about that, because obviously it's been a precious asset, family memories to the family. It's now become a burden to her because it's not being used very often, and yet they still have to take care of the property. And so it's costing her money right now. So emotionally, her just consider insurance, property taxes, maintenance, repairs, all of those kinds of things just to take care of the basic property is costing her upwards of $20,000 a year in expenses. And so because they've had it a long time, they bought this in their early 40s, so it's at least 35 years old, they have a lot of capital gain. And if you remember how the tax rules work on exemptions, if it's a second home, there's no exemption on capital gains. So the whole gain is taxed at capital gains rates. There are several states where on top of the top federal rate, that could be as high as almost 24%, there could be another 8 or 10% of capital gains tax on top of that. We're located in California, where the gains rates are really high on a marginal basis. So Betty's kind of bummed about the fact that not only is this something that she cares a great deal about, but it's costing her money, and she knows it's going to cost a lot in capital gains tax. And so she saw a presentation like this at one point in time, and she remembered hearing that there was a way to take this property and turn it into a blessing, a legacy blessing for their family, and save that capital gains tax. And so this is how it works. And you'll see in this example that this property was gifted into what's called a charitable remainder trust. It's that green box in the middle. If you notice, the value going in is only $500,000. And that's one key thing that we want you to know about these trusts. Does not have to be an all or nothing proposition. And so in this case, Betty needs to have $100,000 from the sale of this property for some other goals that she has. And when Ransom talks about the investing side of this in a minute, he can, kind of talk about how that planning works sometimes with families. But in this case, there are calculations that are done using IRS rules and tables. We happen to use a software package that can run proposals like this very quickly. And so we were able to determine in planning with Betty and her advisor that by putting $500,000 of value into this charitable remainder trust, that was enough to completely eliminate her capital gains tax, where she could have $100,000 of cash out and $500,000 went into the trust. Now, if you notice, if the property net value is $600,000, the whole $600,000 is retained because she's got 100. The charitable trust has 600. So that's one really, really important benefit right up front. Had she not used a charitable trust, this particular example would have been, let me take a look. I think it's almost close to $100,000 in capital gains tax that she would pay. Yeah, so that's a huge
I'm
savings.
sorry, I didn't hear that, Ransom.
Oh, she would have paid about $96,000 at 20%. So again,
There you go.
just depending on where she lives, it could be a lot worse. It could be a little better, but not likely.
Correct. Correct.
And then I do want to correct one thing that you said, that you accidentally said that the charitable remainder trust would get 600,000. It's 500.
Thank you. Thank you.
500,000.
Thank you for that misspeak. I appreciate that. Okay. So right up front, she's got that benefit. She's not had to pay taxes, which means the entire amount of value is going to benefit her.
We did get a question in.
The second nice benefit about the charitable remainder trust is it can, pardon?
Yeah, we did
About
get a
the chair-
question in. Yeah, the amount that Betty Lee retains, is that taxable?
No,
that-
because this calculation takes into account both income and capital gains taxes. And again, it's a complex calculation that takes into account what her marginal tax rate is on ordinary income and capital gains tax. And so I call it right sizing. We right size these designs. In this case, she does not have any additional tax she pays. Sometimes we work with donors who want to do this. They need more cash out. And so it may reduce their taxes, but not completely eliminate it. And it's a function of the size of the property, the amount of gain that's built in and their marginal tax rate, and their age has something to do with that also. And so it kind of puts that all in that meat grinder. So it's a unique calculation for every situation, but we can run those scenarios and give a specific answer to each situation that we're presented with. In this case, that 100,000 is not taxable. Okay. So I just wanted to mention the second benefit of this remainder trust is that it pays lifetime income to Betty for 20 years. And this particular trust used a 5% annual payout. So if you notice on the lower left-hand corner of this particular slide, we're talking about now that Betty has eliminated that $20,000 a year in expenses, and 5% of that $500,000 trust is $25,000 a year. That's a $45,000 increase in income value, if you will, to Betty, and that's for the rest of her life. And so that's a huge benefit to her for income security. And then the last benefit is that because she knew she wanted to make a bequest to charity at the end, and it's built into the design of this particular trust, that's how she's getting some of these tax benefits up front, is that promise to give to charity becomes irrevocable. In a trust like this, she gets that tax deduction in the year she funds the trust. Okay. So just a couple other quick things. A charitable remainder unit trust resets that payout every year based on the market value of the trust every year. There's another variation on it called an annuity trust that locks in $25,000 a year, regardless of the value of the trust going up and down. Those are details that we don't have time to get into today. But I think if you flip to the next slide, I've summarized here. These are Betty's downsizing CRT of vacation home benefits. She's turned $20,000 of expense into $25,000 of income for life, a $45,000 turnaround increase in her family income. There's no more worry about property maintenance. These are things that the intangibles are almost as important to these folks as the financial. Note it was a partial gift. Betty received $100,000 cash on sale. We've done partial gifts of these things, folks, with as little as 10% of the property value on larger properties, all the way up to folks that have said, I don't need any cash out and we'll gift the whole thing 100%. And so it really depends on the size of the property, the financial goals of the donor, and how much tax they're trying to save. In this case, she was able to eliminate that capital gains tax. She converted her cherished family home into a legacy gift to charity. And so just imagine this intangible also, that's deeply important to family. She may have a really, wonderful story she wants to share with her kids and grandkids about the blessing that vacation home was to their family all these years, and how that's going to bless charity or charities that she cares about after they're gone. It means a lot to families to do something like that. And she found a quality CRT trustee to manage her CRT for her. And we always recommend that the investments be managed by a professional. And at this point, Ransom, I know, can share a little bit more detail about why having a good investment advisor and a good investment manager for an instrument like this matters. And maybe we can go back to the prior slide where he can focus on that.
Yeah, absolutely. And there's a few things that I really like about this scenario. One is the flexibility of being able to retain $100,000 for other needs and other goals. It's not an all or nothing type scenario. Also, a lot of times clients get confused when we talk about a charitable remainder annuity trust, and a negative connotation comes up. Well, I don't want an annuity. Well, for purposes of this, an annuity, and for the IRS, annuity is defined by reoccurring regular payments. It doesn't mean that you have an annuity product inside of that trust. It just means that trust is going to make regular reoccurring payments. That's why the $25,000 is set. And in this example, it was 5%. But if the trust was higher dollar amount, 5% would be, of course, a higher dollar amount. There are different ways to structure it, right? Because not everybody can fit into the same shoe. So again, it's critically important to work with a certified financial planner, have a plan, have objectives, and then let your financial professional work those things out as to what's going to be the best solution and how to get into this. One reason that $100,000 is tax-free is because the charitable donation in this particular case would be 40%, and it's enough to offset that income. If you give tangibles, stocks, bonds, mutual funds, property to a charitable remainder trust like this, it's up to a 40% deduction in the year that contribution is made. If you give cash, it's up to a 60% deduction as well. And sometimes, right, and this is where a financial professional can really help. A certified financial planner can help you figure all this out. This year, we've incurred some losses, right? Losses can be beneficial as long as they're used correctly. So harvesting losses and selling things, and then me recognizing that loss personally, and then turning those investments to cash, and then donating the cash and receiving the 60% additional deduction can really benefit me as the donor over time. And so it really just depends on what you want to do and how you want to go about doing it. But again, this is so complex and so overwhelming that you need somebody to walk through this with you and hold your hand and help guide you. But this is a great example of the power that a charitable remainder trust can create, and the flexibility that can create as well.
Great. So before we go on to the next example, I mean, this is kind of the basic of how a charitable remainder trust works. Just to recap again, the reason this works is I just want to share that a property is gifted into the trust before it's sold. And so if any of you out there are thinking, geez, this is kind of an interesting idea, and you're thinking about a sale of a property, you're getting ready to downsize or retire or any of those kinds of things, the number one most important thing to keep in mind is you have to have this charitable trust in place, and you have to make a gift of the property to the trust before it's sold. You cannot have accepted a purchase offer and then say, now I want to put it into the charitable trust. You certainly can't do it with the proceeds afterwards. The The trust instrument itself is a not-for-profit, non-taxable entity. And so just like in your living trust, in order for the living trust to protect your assets, you've got to deed it in. You have to do the same thing with the charitable remainder trust. So the number one thing we always say to people, if you're interested in this, get a hold of us and do not sign a purchase offer until you've made a decision. And so if you only remember two things, one is I heard I can get some really good benefits by gifting into a charitable trust. And two, I have to call somebody that knows about this and get the details before I accept the purchase offer, then you're in good shape. We just did one. It was the fastest one ever here. I've never done a CRT before where from the day that the donor said, can you show me how this works, until the day it was gifted, sold, and closed the property, it was 24 days. So we can do it quickly if you're under the gun to do something, but just keep in mind, don't already have the property under contract. Otherwise, we can't make it work.
All
Right.
right.
I'll
Okay.
point out one other quick thing too.
Sure thing.
The reason that doesn't work is our tax code is essentially governed by 5 doctrines. One of those doctrines is the doctrine of constructive receipt. And so that basically just says that if you ever receive money in your hand, check, cash, or otherwise, it is a taxable event at that point, and you can't unscramble those eggs once that's done. So make sure you've got a plan in place before you receive any cash. It can go to a third-party intermediary and be held away from you as long as you never touch it or are in possession of it. But again, that's why it's so critical to work with a professional that has done this, been around the block a few times, and won't let you shoot yourself in the foot by making a goofy mistake.
Yeah.
Thank
That's
you.
a great point. And we really encourage people to explore this early if you're thinking about it. We often help people with proposals, and they may not make a decision for 6 months or a year to move forward, but they have the information and can do the planning. It's great idea. Okay. So with those basics in place, then so we've talked about downsizing, and it can work for second properties, rental properties, commercial properties, even primary residences. We just factor in the exemptions. The next thing that can happen to a whole lot of you is that you're business owners and you need to sell your business to fund your retirement. And like a lot of businesses, your business is your nest egg. And capital gains taxes may be built into that also. You're trying to figure out how to not take that haircut on capital gains taxes. And so most of us don't want to have to work till we die, have succession planning in place. And so using a variation on the theme of this is that we can use the same CRT ID. We call it a retirement CRT. And again, it can be part or all of the business interest can go into a CRT. The size of the CRT of the charitable trust can be adjusted to minimize taxes and maximize cash to owner. Again, it builds in lifetime income. It's possible to include children and a gift to charity when you do this. And so let's take a look at this example. We're calling this the Smith family example. You see the model looks very similar. The fact pattern again is unique. This is the Smith family. They're age 60 years old. They have a family business that needs to be sold. And I'll just point out that family businesses can be held as sole proprietorships. They can be in S corps. They can be in partnerships. They can be in private C corp structures, or sometimes it's a combination of those things. When we move into this realm, it's pretty important to expand your advisory team to the group that we've already talked about, meaning a good charitable gift planner, a good financial advisor, good tax person, and perhaps a business attorney also that's helping you, because it's a little more upfront effort to examine the type of structure that you have your family business in, and which either structures or assets inside those structures are the best candidates. So just know there's more specific planning that goes on, but you're going to see here very quickly that the benefits are substantial, certainly worth your effort. Okay, so this is the Smiths. They're 60 years old. They do want to sell this family business. And the property, they know that they could reap $6 million because they built it and own it for a long time. Their cost basis in the business is very low. And so they're staring at a pretty large tax bill to be able to sell. And so this is another case where looking at all of the planning, and again, without going into the details of how we can run the specific design of all of these things, they wanted to be able to retain assets outside of this trust for all kinds of reasons. They knew that there was a large portion of this that they wanted to lock in for their lifetime income, just like you might pre-fund a 401k or an IRA or something like that. They always knew that a good chunk of the value of their business would be their nest egg to fuel their lifetime income. And so in this case, by putting in a little over half, $3,500,000 of value of appreciated property into a charitable remainder trust, they were able to reap lifetime income for 2 lives. And we did this on 2 lives. This is a case of husband and wife. And the IRS calculations take into effect the life expectancy of both partners. So if, John Smith was 60 and Sally Smith was age 55, again, you get that benefit of the longer life. And the other thing is, this is actual lifetime, not life expectancy. If the life expectancy takes them up to age 90 and they live to be 105, this trust lasts until they're 105. So there's no end date except when they pass along. And so in this case, I just simplified the slide a little bit, but over their lifetime, the income to them on that $3.5 million trust is set over $7 million. They have that $2.5 million that's coming out directly to them. And again, this was right size so that comes out tax-free, which they can use that to do their retirement home, to lock in healthcare, to buy whole life insurance, which I know Ransom wants to talk about. Just have other cash available that we all want to have available that's spendable. Keep in mind the charitable remainder trust is irrevocable. A family is not able to reach in and pull principal out except under a fairly unusual situation where you try to do a trust termination, but don't think of that as an option. And so we always want families to have good planning alongside on this right sizing idea. And then again, this is a family that's very charitably minded, and this pre-funds, if you will, the bequest to charity that they wanted to make. I made a note in here that it says charity-DAF. That stands for Donor Advised Fund. Here's another neat thing about charitable giving with a charitable remainder trust. A family donor advised fund can be named the charitable beneficiary. And although that money will go into the DAF after the family passes away, they can leave instructions with the DAF sponsor for how they would like that money managed after they're gone. They can list the name of the charities they'd like. They can have that converted into a long-term giving fund, even an endowment fund. They can also nominate their children to be advisors and to advise on part or all of the charitable distributions after they're gone. So there's double flexibility built into this particular design. We are Christian Foundation of America. We're in the charitable side of the business, so we're always encouraging and really talking on the creativity on the charitable giving side of things. But again, it's part of an entire financial plan that can help a family realize all of their benefits from running this business and to lock in income security, asset security, and their legacy planning. And I'll stop there, Ransom. You can.
Yeah,
well,
no,
let's go over the benefits first. Let's just cover this first, and then Ransom, you can kick on this. Here, look at what happened. They were able to convert their income from running a business into a retirement income stream with a partial gift. That partial gift meant that they also received substantial cash for investment and family goals. They didn't have to worry about running the business anymore. The family reaps income and a retirement lifestyle. They have an option for children to receive income from for a period of years after the parents pass away. It's called a guaranteed years benefit that can be baked in. A question we often get is, well, this is really great, but what if something happened? What if we died in a car accident at age 65? Haven't we kind of shortcutted the family benefit? Well, it is possible to bake in what's called guaranteed years for up to 20 years. And that usually satisfies most families' worry about maybe dying a little bit sooner than they thought. It satisfies their desire to leave a bequest to charity because it's baked into the structure. And again, we always recommend using a CRT trustee to manage. These instruments themselves are compliance complex. Ransom made an earlier comment about the four-tiered income that has to come out. There's trust accounting that has to be done. There's an annual filing that has to be done. The calculations for annual payout, just managing the gift going in, and the administration over years and the maturity of the trust is pretty complex. You can find low-cost trustees, many places. We do that, and that way they're not bogged down by it. And the other thing that's important is the big pool of money. You want that money professionally managed, and that's where advisors like Ransom come in to help out. Okay.
Oh,
Ransom, take it
absolutely.
away.
And I'll reiterate on a couple of those facts too. There's essentially 21 things that you have to do as a trustee, and they're all required or you would be in contempt of court. That's kind of how the whole trust process works. I had a client years ago that was appointed trustee. He was kind of honored and really, went in head first and had all the right intentions. But then when he started to get into it and figure out the complexities that's involved with being a trustee, we then sought out a corporate trustee to take those over. Just the trust accounting income in and of itself is vastly complex. And then the other 20 things, the 20 boxes that have to be checked are just nuts. So have somebody do that that's done it before. It'll make your life a whole lot easier. And the last thing you want to do is upset the IRS. One other key thing on the business owner, many small business owners typically own the property and the building that they have their small business in. And one of the things that often goes unchecked or unlooked at is that if you have a good CPA, right, you have been depreciating that property and that building for years. When you sell that property in that building, you have to recapture that depreciation, which is sometimes pretty painful. So that's an additional tax benefit to doing this, where you don't have to recapture that and pay taxes on that depreciation that have benefited you for so many years. So it's really just kind of another cherry on top that allows you to even save more. And most people don't think about that recapture, but it can be significant, especially if you've done it for the 20 or 30 year time frame, where it was identified as 20-year property or 30-year property and you've depreciated it fully. That can be pretty painful. And all that means is just less money in your back pocket. It's not about what you sell it for. It's about what you get to keep and how you get to benefit from it. So that's something to consider as well.
We did have a question, and I did want to address this while we're on this slide here. The question is, how did that $6 million increase to income to two lives for over 7 million? There was a question there. How did that work?
Right. So, and this is a projection based on the expected lives of these two people. And so if you look at the $3.5 million going into the charitable remainder trust at 5%, that's $175,000 a year income. And so, and there's also built into these ideas an investment return over time, so that the trust is earning income. And so the trust principal, you can see, is only dropped from 3.5 million in this particular example down to 2.7 million. So there's investment return going that's building up inside the charitable trust every year. And because the trust entity itself is tax-free, folks like Ransom can use all the tools in their toolkit to create investment return. And so this investment return on a gross basis may be 6% or so. And this trust payout, I don't have the details in front of me, but This may have been a 6% payout and a 5.75% net return or something like that. We use pretty conservative projections, but somebody can do that a long time. So the investment income is building up inside of the charitable trust. The trust itself never pays taxes. And so that all builds up tax-free. It's almost like it works kind of like an IRA, because while it's increasing the gains and income inside the trust itself doesn't pay tax. It is taxable income to the extent of the four tiers of income that build up inside the trust coming out to you. But consider an IRA. When a 401k or an IRA, when that income comes out to you, it's all ordinary income. With a trust like this with capital gain coming in, there's a good chance that over your lifetime it's going to come out as partially ordinary income, but partially capital gain income also. So it's kind of a long explanation, but if it's $175,000 a year in the initial year, and envision the trust is making income and it's paying out to you, but over time that trust principal is staying fairly steady. You can see in this case it goes down a little bit. That over 2 lives, and at age 60, this is probably close to a 30 or 32 year estimated life expectancy on this particular trust. That will accumulate to $7.1 million of lifetime income.
Thank you so
Yeah,
much.
those are all great points. And a lot of people tend to think that when you hit retirement, right, you take your foot off the gas and you just coast in from an investment perspective, but you very well may live another 30 years in retirement. Right. And if you think about what all's happened in the last 30 years, it's amazing to think what's going to happen in the next 30 years. So Definitely don't take your foot off the gas. You may want to take your foot off the gas and slow down a little bit, but don't turn the engine off and coast in. Right. There's a lot of chance to make a lot of good return. And think about this too, if I'm paying out 5% and I'm making 5%, then the trust is sustainable. It hasn't eaten any of the principal yet, which is ideal. So if you can go out there and get a 6.5% return, then you're just compounding things at a faster rate, which allows that money to grow at a more sustainable rate, which is perfect. That's ideal. We're not always going to get the target return. Like this year, for example, markets are down 22%, but there are ways to be very conservative, fixed income, treasuries, you name a lot of different things that can help you get to where you want to be.
The other neat thing about using a charitable remainder trust, business owners may have been putting money aside in a 401k or some kind of a simple retirement plan along the way, but again, thinking that this is their major nest egg that they're going to use. Unlike retirement assets, where especially if it's in 401k or IRA structure after we're gone, we're likely subject to the IRS's increasing percentage payout that we have to take. It starts at, in the low 3% in our early retirement years. And by the time we hit 90, they're requiring us to take out, up to 10% a year. Well, that's tough. If people don't really need it, they don't want to have to pull it out. Where this charitable remainder trust, if the payout is locked in at 5% or 5.5% or whatever that percentage is, that never changes. And again, it works really well for a family that knows they've got other sources of assets or cash, and they don't want to be forced into what we sometimes hear people say is they're forcing them to take down income they don't need, because of course the IRS wants their tax money on it. So it's a nice way to level out that payout, and particularly when there's charity in your legacy plans at the very end. It really helps to with a long-term perspective, and an advisor then can take a long-term point of view on a trust instrument like this. They don't have to necessarily convert the investment program into cash only or cash and very safe fixed income in the last few years. They can really maximize the investment programs and the investment return for the entire legacy plan of this particular example.
Good point.
Okay, so our last story is about IRAs, and this is something that we're seeing much more popular ever since the IRS changed the stretch rules a few years ago. So this is all about Jack, who has a pretty good size IRA account. He's looking for a way to have his IRA go to his kids and avoid the really high tax cost. So unlike most family assets, retirement assets are taxed at ordinary tax rates when the kids inherit. And so, if your kids are going to inherit your IRA account or your 401k account, they take it out in a lump sum. They're going to have to take it all in as ordinary income. It may push them into a higher tax bracket. It can really sting that amount. And so, like a lot of people, his nest egg is their home and their retirement accounts. And he plans to have a good chunk of his IRA passed to his kids. So when the IRS reduced that stretch provision, it used to go 20 years. It now only goes 10 years. And so the kids have to withdraw all of that over that period of time. But they left in the rules an exception, and we call it a retirement charitable remainder trust. But it's possible, and this is something that is done in conjunction with your estate planning and your living trust, that you make a provision in your living trust that your IRA assets, part or all, will be used upon your death to fund what's called a testamentary charitable remainder trust. And in doing that, Jack can have his kids receive that inheritance over a 20-year period of time. So let's take a quick look at how this one works. Okay, so we call this a testamentary CRT. Sometimes it gets nicknamed to give it twice, and you'll see in this case, why it's being given twice. And so Jack put this into his estate plan. He passed away at age 87, has 2 kids, and he wanted them to be paid out inheritance over a 20-year period of time. So this one's pretty straightforward, that the IRA was valued at $600,000 at his death, and he instructed for all of that to go into a charitable remainder trust. This one was sized at a 5% payout to his 2 kids. And so in this case, Jane and John are going to receive $15,000 each over the next 20 years. There may be, and I'm sure Jack did provide that they were going to receive the house. They may have had other investment assets or something that could pass over to the kids tax-free, right? Because there's a step up in basis that happens with assets other than retirement assets with inheritance to kids. And so this is a way to stretch that out over a period of time. And then the remainder goes to charity at the end. And so again, it's a very simple idea, but it's a powerful one, because this avoids the kids having to take it faster than they want to, or faster than Jack wants them to, is probably the better answer with everything that he's done. It avoids that upfront tax on the principal assets. This is a way that Jack makes his charitable bequest after the end of the 20 years to the kids. And so this maybe his total estate was worth $6 million and he decided he wanted 10% to go to charity. Well, by doing it this way, he's able to reap these benefits for his kids, really avoid taxes on his entire estate. If it's an estate that's under the about $12 million in value, lock in that gift to charity and have a tax-free transfer to his family. So we can go to the benefits slide on this just to summarize all that. And then it's just really neat to see these things happen. So his living trust included a testamentary CRT to ensure that the kids' IRA inheritance stretched over 20 years instead of the IRS's 10-year limit. It's called a bypass of that 10-year limit. That gift provides a charitable estate deduction at the time of Jack's death. So for very large estates, it's possible for the estate to get a benefit when that happens also. Other assets like his home can be inherited with no taxes because of this step up to fair value at death. And they can be sold for a lump sum inheritance tax free. And this satisfies Jack's desire to leave a bequest to charity with this structure. And again, by having a quality charitable trust trustee and a good investment advisor, he's not burdening his kids with administration of this inheritance structure for them.
Right. No, that's good too.
Ransom.
I like this one. I've had several clients over the years whom I'm going to stereotype a little bit here. They have 3 kids. One of them's fantastic, did everything he was supposed to do. The middle one has made bad choices his entire life, and then the third one is a free spirit, never went to college, and kind of bounces from job to job, right? So I've seen the detriment that a lump sum of inheritance can do to people. It can actually impede you from living your normal life. Even though it sounds great to get a bunch of money plopped in your lap, it can be overwhelming and actually be a deterrent for these people. So this allows that income to be kicked out without the lump sum or the burden of the lump sum benefit to the inheritees. So think about that too. I'm sure one kid's fine with getting the lump sum. He's probably going to invest it in his new company and going to be fine. The other one's probably going to buy a sports car, pay their house off, and take a vacation, and that money's gone. And the third one is probably going to drift around and spend that money over the course of a year and then be wondering where it all went because he has nothing to show for it. So this is a smart way to leave a legacy that's funded annually and not overwhelming. And the idea of inheritance, at least what I believe is, I don't want my kids being in the Taj Mahal fanned and fed grapes, right? I want them to be able to do a couple of things they weren't able to do otherwise. And that's where this can significantly propel them forward instead of deterring them from accomplishing their own life goals. So very powerful stuff to think about.
It is. And, when you can really, Ransom, when you think about, the 3 ideas that we've talked about, so far today, it's really, we love our kids equally, but they're unique. And so we ought to think about the best way to leave inheritance to them in unique ways that, provide incentive to them, as well as the gift that we intend to leave behind. And so what you just described is so important to most families. And so you can start to see how using a combination of things like this, you could really think about the best way to leave inheritance to family members that speaks to what's happening in their lives and what parents or grandparents would really like to do as part of their estate planning.
It's funny, a good friend of mine once said that, and I love my kids equally as well, but that I wouldn't take $10 million for either one of them, but I wouldn't give 50 cents for another one.
Yeah. Good. So this slide is just really quick. The sort of how and what to give into a charitable remainder trust. So on the left-hand side, you can gift all kinds of assets. Cash is always acceptable. Ransom said, sometimes gifting cash is better if there's a loss because you get that higher 60% of AGI. Appreciated property limit is 30% of AGI a year, but remember it carries over for up to 5 years. And so even if you can't use any of these deductions all in 1 year, chances are you won't lose them over a 5-year period of time. Any direct gifts of stock, mutual funds, other securities from brokerage accounts, and that can include privately held C Corp stock. Appreciated assets are always good because you avoid that capital gains tax. It's a double benefit. We just talked about why you would consider IRA or 401k assets at death. We touched on real estate or business interest. Again, when there's long-term capital gain built in, you want to think about those things. And then the how, obviously cash is always by check or bank transfer. Securities, like the conversation we had with real estate, in order to reap the benefit of avoiding capital gains tax on appreciated stocks, that's an in-kind transfer, broker to broker. It's not sold first. IRA or 401k assets, it's a pay on death beneficiary designation, always smart to have it recorded in your living trust so it's consistent. Real estate or business interest, the techniques will depend on asset type, but in general, there has to be a title transfer of the asset into the charitable trust before there's a sale. And then you can set up testamentary charitable remainder trust. We talked about that with the IRA, but you can set up testamentary charitable remainder trust for all kinds of other reasons. And that's included in a will or living trust. I often see the technique that the actual charitable trust instrument is set up and the TIN is set up ahead of time. We're hearing sometimes that financial institutions want a TIN, a tax ID number, in order to lock in that beneficiary or pay on death instruction.
All right.
Okay.
Oh, I'm sorry about that. Go ahead, Kathy.
I'm done. I think this is Ransom's.
Yes, I believe we'll transition over to Ransom,
Yeah,
talking
so-
a little bit about life insurance. And I'm excited to hear what you have to say on this one.
Yeah, so with any financial planner, right, I want to provide my clients and my audience with suggestions and alternatives to what they're currently doing to enhance and complement. And life insurance can be one way to do that. So there is such a thing called an irrevocable life insurance trust. It can cost less sometimes than setting up a charitable remainder trust, but then you can also have your beneficiary of the life insurance be the charity. And then they get 100% of that benefit when you pass away. And sometimes the charitable remainder trust doesn't fit, or maybe you don't have the assets or you don't think you can do it. So I encourage you again to explore these things with a certified financial planner and just make sure that you're aware of all the options. The way the life insurance trust works is that it owns the life insurance and it controls it. And what you do is you make a gift into it. The trust then pays the premiums on the life insurance. The trust also handles the distributions of the death benefit when the time comes. And it's just another way to be able to pay out. A great example of this is I had some clients that had a nice, decent level of assets, but based on their current trajectory for spending, they just had enough money to take care of themselves. And that was about it. But they also had a goal that they wanted to give $1 million to 2 different charities, so $500,000 each, but they didn't have enough assets to set that $500,000 aside because they needed it for income to pay bills and take vacations and do all the things they wanted to do. So what we did is we got a life insurance policy, named the 2 different charities the beneficiary. So what we did was we leveraged their current wealth, let them play and have fun for 25 years, and then when they pass away, that money is going to the charity. So they did get to accomplish both goals. And what that was is the charities were due to family members passing away from different cancers and MS and things of that nature. And so they wanted to benefit those organizations, but they just couldn't do it. They weren't willing to reel their laps back in that far in order to make that decision. So it was just going to be a foregone goal, but we came up with a way to accomplish that and let them fulfill it. And this again is just a flow chart where the grantor makes the premium payments as a gift to the trust. The trust then pays the premiums, and then when everything's said and done, you've passed away, the irrevocable life insurance trust takes care of paying out the proceeds and distributing all of that to the beneficiaries. And that can be anyone you want, or any organization, or any entity, or any person. And it's just another alternative on how to get to where it is you may want to be on down the road. The next slide is again, I can't emphasize how many times I've seen things go awry because somebody read something, saw something, and they start off on this path, and then it becomes a path of destruction. And like I said, right, that it's so hard to unscramble eggs. So make sure that you have some guidance in this process, and use a trusted financial advisor. I mean, I'm a certified financial planner, like Marche mentioned, so I'm a big component of the education side and really just helping people explore alternatives and different ways to accomplish what it is they want to do. But again, please engage a financial planner to help you with this. It's overwhelming, but pick somebody that's been around the block a couple of times and has done this before. Absolutely.
I'm going to go.
Yeah, no, go right
Sorry.
ahead. I know we had questions come in.
We had a couple questions. I know we're at the top of the hour, so we want to be mindful of your time Kathy's time, but we'll take a couple of these and then we'll go ahead and close. Question came in, which is better on doing that life insurance strategy, term or whole life or permanent insurance?
Yeah, that's a good question. Term insurance is great to help you get from A to B. For example, if I had young kids and something were to happen to me, there's a lot of raising left to be done, a lot of things to pay for. So term insurance, you get a big bang for your buck, more coverage. For a life insurance trust like this, permanent coverage is more prevalent, just because you don't want to set all these plans up, have a 10-year term, and then on the 11th year, day one, you pass away and no longer have the term insurance. All that planning and all that structuring was for naught. So you want to make sure you've got something permanent in place. Whole life is typically not a great product for these types of endeavors, just because we can have different policies that focus on, usually a universal life is more flexible, but a different policy that focuses on just the death benefit, not necessarily the cash value side. A high cash value policy would be more of an investment tool or a retirement type plan, or savings. This would be more for the death benefit and working towards that high death benefit, which lowers the premium cost, which makes things more affordable and easier to do. Good question though.
One other question here, does the insurance trust have to be set up prior to getting life insurance?
There's a way that you can transfer the ownership of the trust, of the insurance into the trust. Depending on the cash value and the cost basis, there may be some tax consequences to it, but it would be very, very minimal. It could be, most of the time it's going to be very, very minimal. But that can easily be done. And essentially what you're doing is you're making a gift to the trust. And if the life insurance is over a certain value, then that's a taxable gift. And we have to compensate for those taxes and pay them, or the IRS will be knocking on the door to have breakfast with you every morning until you get that paid.
All right. Kathy, we had a couple questions for you and then we'll close this out. The question came in, what is the role of the trustee in a CRT? Can you explain a little bit about how that works?
Sure. Yeah, think of three kind of major parties to a charitable trust. The person who donates into the trust is the grantor. The folks who receive income for life are lifetime beneficiaries. The charity that receives the remainder after the trust is over is a remainder beneficiary. And then sitting in the middle is a trustee. It's a trust, and so it needs a trustee. That's the manager, the administrator, the compliance officer, all of those jobs about managing that trust instrument from inception till the end. And so it's their job to make sure that the trust is, once it's set up, that the gifting is handled properly, that the tax receipting is handled properly, that in the case of property sales, there are very specific steps that you have to go through to satisfy the IRS about all of that: valuations, reporting, tax reporting, the computations of the income that's paid out, particularly the ones that reset every year, and all of the reporting to all of the beneficiaries, and then the wind down at the trust at the end. So it's really it's all of that administration, compliance, management, and reporting of the trustee. And part of the trustee's job, is also overseeing the investment management. In our case, we primarily use outside investment advisors, often use the advisors that are already with the client on larger accounts. And so there's a lot of work to be done on the inside. And I think we both talked about, the fact that these things are complex. Ransom, I never counted up all of the steps you have to do. That was an interesting tidbit. We just do it. But yeah, it's a big job. And I will say this, that, unless you are yourself a professional with pretty deep experience, we've taken over a lot of existing charitable trusts. Rarely do we see that they were handled properly. We usually spend the first year or two straightening out things that were not handled correctly. It's just not worth it. The IRS will audit, gifts into charitable trusts. And so you want to have your ducks in a row.
All right.
Good point.
And one last question, maybe for both of you here. why would people choose a charitable trust or insurance? What's the big advantage to those, just as kind of closing statements?
Ransom, you want to go first?
Yeah, so I mean, I would just say the just accomplishing the charitable gift, right? A lot of people that are in this position and that are my clients and that we deal with have been very blessed, and then they have had fantastic careers. They've saved money, they've invested over their entire lives, and they're in a position to give, and most of them want to. And so I think the satisfaction of the gift and seeing the benefit of it, right, or the future benefit of it, but then at the same time, right, like I my number one objective is to disinherit Uncle Sam. So if I can accomplish my goal by gifting and doing right and leaving a better legacy for my family and the people that I love and the events and the organizations that I care about, I want to do that. But then on the backside, if I get to jab Uncle Sam just one time, like I love that too. So it's a good thing to be able to give to charity and then to benefit from it on the tax side too. And I think those are the two biggest keys, right? Is the benefit to the charity and then the tax savings to me as an individual.
Yeah, I think you've said it well. The only thing I'll really add is that I've been working in philanthropy a really, really long time. And of course, we've watched, rules, Congress, change legislation and rules for many years, taking away a lot of, tax benefits and tax advantages and all that kind of stuff. And all that time, they really have not touched this charitable remainder trust area. Uh-oh, my screen went off. Is your screen still on?
No,
okay.
You're fine. You can go ahead.
Okay. Anyway, and so it's one of those unique things that's still out there where a family can accomplish several of their goals in this one instrument. And by recognizing their commitment to charity that will happen after they pass away, to be able to have this accelerated tax benefit, consider how powerful that is, that you can retain all of your net proceeds on these assets, invest, some are all inside a charitable trust, even keep some outside of a trust, what that does to advance your total family legacy planning. They're just powerful. They're very flexible. They're one of the most flexible giving instruments still out there. So we really encourage people to at least learn what's possible.
Well, folks, thank you so much for being here. I want to thank Kathy and Ransom for being our speakers today and for the organizations that have worked with us to bring you this presentation. To our attendees, look for an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you everyone for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Bye.
Bye.